Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. FOMC decision is out, and after FOMC, I like to play this game called Guess What Happened based on the market movement post FOMC. Stocks are up, and most currencies have strengthened against the USD, and there has been a good rally in gold. Makes you wonder what happened, right? Let's find out from JK. JK, please break down yesterday's FOMC for our listeners.
Good morning, Swaraj. Yes, Fed got the early bird price for gifting the first Santa, gift for the markets and turning, dovish against the market's overwhelming expectations that they will continue to push back against the market's expectation of rate cuts. They really provided the boost to all the markets. The Fed statement itself, while saying the decision to pause was unanimous and that inflation had eased out but remained elevated, referred to slowing economic activity and job market easing and that tighter financial conditions were expected to weigh on economic activity, hiring, and inflation. So things did remain uncertain, but they did indicate that the peak rate was in. And we had the summary of economic projections from the Fed members, which showed downgrading of GDP for next year by 0.1%, 1.5 to 1.4, unemployment rate unchanged, core PCE inflation downsized from 2.6 to 2.4% for 2024, remaining broadly unchanged for the rest of the next 2 years. And then most importantly, the Fed funds rate, which was projected to cut by 0.5% in September dot plot, has now gone up to 0.75%. That is just 0.25% below what the market had been expecting before the Fed decision. So they now expect the Fed funds rate to close at 4.6% in 2024 as against the 5.1% that was projected in September. Now, no member actually sees a rate higher than what it is now. And in Powell's speech also, he clearly said that the rates have seen their peak. He said Fed is not likely to take rates further higher, and that the Fed is very focused on not making the mistake of keeping rates too high for too long. So these are very clear dovish statements. And what we feel is that Fed dot plot as well as statement is clearly a dovish tilt in the policy, moving towards market projection of rate cuts. And it appears that the latest employment and inflation reports, which had given some doubts to the market about whether Fed will continue with the same projections, that has been belied, and they have actually ignored the latest reports. Because if you look at it, the inflation numbers have been dropping steadily over the last several months. From 9.1, we have come to 3.1, just 1% above the Fed's inflation target. Unemployment situation has been worsening, or rather, I would say job market has been easing for quite a few months. This month's number was slightly higher, but nothing big. And wage inflation was just up for just this month, and otherwise it has been steadier. So taking all these consideration, and also the several other indicators like manufacturing, ISM, which has been in the contraction territory for the last 12 months, leading economic indicators which are soft, and also the consumer confidence, which has been low, or rather falling. I think these are the things that have led the Fed's decision. And of course, they do keep in mind that keeping too high rates for too long is likely to probably lead to a recession, which they would like to avoid. They want to achieve a soft landing for the economy. And as we have been saying, the employment and inflation indicators for the last several months would have prompted them to keep the policy somewhat dovish this time. Now we are in alignment for Fed's dovish turn, but we do suspect that the markets may start to expect even more at some point, and Fed will have to once again keep pushing against their expectations. They would not like to ease the financial conditions substantially and in quick time, because that can reignite the inflationary pressures. Some fear is that if Fed is ready to pivot closer to market expectation, they have started to probably see something more serious about the economy. That is also one more point. One more point to note is also that, Fed, while they have indicated 0.75% cut possible next year, it is not a decision. It's only individual members' views that has been expressed. And more importantly, no timeline for the first cut has been indicated. We might as well see the first cut happening in the second half of next year, and that may actually be not to the liking of the market. But whatever it is, all the markets took the Fed decision with both hands. Dow hit all-time new high yesterday. S&P 500 and the Nasdaq indices hit 1% higher for the day. And then we had the yields which dropped substantially after the Fed decision, with the 2-year yield falling closer to 4.5, and the 10-year actually has broken the psychological level of 4%. So that's a big reaction from the markets. Now we can see that the yields have fallen more than 1% from the highs that was seen not too long ago, and that actually helped the rally in other risk assets as well. As far as the currencies, I think dollar yen has taken the big lead on gains because it is now trading below 143, and possibly targeting 140 in the near term, because the differential with the US from Japan has fallen substantially. I am sure some carry trades would be unwound in the coming days. As far as euro is concerned, it's almost 1% higher. This is despite the fact that ECB itself may be closer to announcing similar projection on the rates. It's only the BOE that can actually push back more against the market expectations. Although there also now expectations have risen to 1% cut as far as the market is concerned, because this has been triggered by the GDP number, which came at minus 0.3% in UK for the last quarter, as against the flat growth that they were expecting, and this was a big hit. So GBP, of course, gained because of the overall dollar weakness, but it is definitely lost against the euro. The euro GBP has been higher. So that's the big reaction that we got from the markets. And also, just to note that just before the Fed decision, we also had the PPI inflation number, which showed deflationary trend in almost all the segments of the report, the core as well as the headline number. So I think Fed would have had insight into these price pressures development, and that's why they have actually gone in for these. But where do we see from here? I think dollar is definitely going to be weaker, although the momentum can be much slower in the coming days because we are already heading into the holiday period. Yields, I don't think now having dropped more than 1%, I think yields will find good support around current levels. Let us not remember. Let us also remember that there is a lot of borrowing that will come up from the treasury in the coming months as well, and their new fiscal has started from October, and they will be borrowing a lot, and these supplies will also be weighing on the bond prices, or I would say the yields to remain supported. And then there will be no price for guessing where the rupee has gone after these decisions, because we have, while there was a knee-jerk reaction, we are already seeing the rupee trading about 83.30 in the offshore market in Asian hours. So it's as if nothing has happened. And I mean, if we need to see a bigger reaction from the rupee, not only to the Fed decision, but also to the flows that we have seen increasingly of late. Most factors now working for some strength in the rupee, including the big fall in the crude prices. But all that requires a change in stance on the currency policy by the central bank. And until we see that, it is better not to assume any bigger trend emerging. I will get excited only if we start closing below 83. Otherwise, we are going to be in the same range. Thank you.
Thank you, JK. And just to quickly summarize, Fed turned dovish against market expectations, and and they against market expectation that they will push against any sort of dovishness which is being expected by the markets already. The statement did indicate that we are in a peak rate situation. Dot plot showed a slowdown in economic growth and fall in inflation. And the Fed fund expectations, Fed fund rate expectations by Fed members, which is again a part of the dot plot, indicated more cuts in 24 than the previous statement. So overall, a dovish tilt being played out, and an early Christmas for the markets, with Dow Jones hitting all-time highs, yields dropping substantially, with the 10-year breaking the psychological level of 4%. Rupee, nothing home to write about. After a knee-jerk reaction, it seems it's already trading above 83.30, as if nothing has happened. So, as JK mentioned, only a break below 83 will lead to any substantial move. Otherwise, we'll be in the same range. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.